So interest rates are rising, and everybody wants to know, and probably you as well, is what does that mean for your real estate portfolio? Should you be buying? Should you slow down? Are interest rates going to keep rising? And what does that do to real estate valuations, particularly in the multifamily space? So to answer that, I have a good friend here who I've known for a number of years. Andrew Westling's with us. Welcome, Andrew. How are you doing today?
Thanks, Bronson. I'm doing great. Appreciate you having me.
Oh, it's really great to have you. Now, just so everybody gets some context here, Andrew is a vice president at Walker Dunlop, which is a group that does lending, and he's been in this world for quite a number of years. And he's spoken at my local meetup as well. Very, very knowledgeable as far as what's happening today. He's got some really, kind of some tales from the trenches of things that are happening, trying to get deals done. So, why don't you give us a quick little bit? Just talk to us a little bit about what's happening right now with interest rates, and how do you see that impacting getting deals done or even asset valuations?
Sure. It's such a great question right now, and it's so topical. As everyone's hearing about, the Fed continues to raise short-term interest rates, which is dictated by the Fed funds rate. And what we're seeing is typically that affects floating rate debt and shorter yield or shorter duration loan periods. But what it's also doing is it's translating into the longer fixed rate loans. Now, not bit for bit, let's say, but as they raise 25 or 50 basis points on the shorter part of the curve, we're seeing that flow through into the long as well. And so overall, we've all seen interest rates rise. It's been a bit of a shock to the system as the Fed continues to combat inflation. And what we're seeing now is finally a little bit of pricing relief in certain markets and certain asset classes, but we're seeing 0 to 5% price reductions for assets that were put under contract, call it 60 to 90 days ago. What that tells for the future is still TBD, but I can tell you that people are still transacting. There is a lot of capital in the space. And so we thought that this would have some effect on the volume of transactions slowing down, but we've yet to see that actually impact the market, especially in multifamily and industrial real estate.
So we're recording this mid to late May. It will obviously come out later, but it is interesting to see because we've been talking about that for a long time, right? That something would cool things off because everything has just been on fire for the last couple of years as far as pricing, as far as so many buyers, whether it's single family, multifamily. And like you're saying, there's some sentiment is kind of cooling down, which actually can lead to some deals or even things that we've seen that maybe we lost or, we didn't get the deal are actually coming back to us. Or maybe somebody, we got something under, we're about to go under contract. I'm like, we actually need a little bit less, we need a lower price because we didn't figure interest rates would be this high. So there are some real positives to it. What would you say real quick?
Sorry, Bronson, to interrupt. The really interesting part is that this is so different from what we've seen in the past. And I think what a lot of people have been doing over the last few years is putting together a war chest and saying, man, I can't wait for prices to drop and I'm going to buy, and I'm going to load up, at bargain prices. But that's not happening. And I don't think it will happen. And there's a couple of big reasons for that. And they're kind of macroeconomic. And the first is truly in multifamily, overall supply and demand, we have huge shortage for housing, right? Ultimately. And so
6.8 million, right? 6.8 million apartment units
nationally. And so obviously you'd have to dig into market specific to make sure that new construction hasn't put oversupply in that market. But generally speaking, we're trading existing stock of multifamily assets between buyers and sellers. Not as much new construction. Some obviously over the last few years, but that has slowed down remarkably as interest rates have ticked up here recently. And so what that tells me is despite rates going up, this is still a desirable asset class. Just that reason alone. But secondarily, what we're seeing, especially at the institutional level, is that some of the biggest operators in multifamily have made a bet. And that bet is that rent growth will outpace inflation. And so they're looking at this and going, you know what? We understand that inflation is real and it is well beyond our government's control and probably realization of how bad it got. But they think that they can raise rents on existing stock of multifamily product to outpace inflation and still keep their returns doing well through this rising interest rate environment. And so that's really different. And so that is keeping price points and cap rates relatively stable as opposed to seeing a pullback that I think we all had hoped for.
Yeah, this is something we talk about a lot is the macroeconomics, right? Because in 2008, if you were only paying attention to real estate or only paying attention to your asset, whatever it was, you could have gotten you just completely your hat handed to you, because there's this global economics thing. All this stuff is going on with all the money printing, all the money creation or asset, debt that we have, and so something like 40.9% of an increase over 48, or it was a 24-month period. That new money is in the system and it's got to go somewhere. So I'm also kind of like you, is like saying, hey, the macroeconomic picture looks very different, where interest rates can go higher, inflation can stay high, and rents can go even higher. And that's what I think a lot of people kind of have trouble seeing. And so let's take a pause on that for a minute, because I want to come back to it. There's so much good there to talk about. But tell us a little bit about how your story, real estate, how you got where you are, because you've just done a whole lot. I want people to know you and know what you do and kind of know what you bring to the table.
Sure. So, as you mentioned in the start, our firm is Walker Dunlop. We're a national real estate investment sales and finance firm. In 2020, we were the fourth largest commercial real estate lender in the country and the largest provider of capital to the multifamily industry. So that is a big part of our business. Personally, I've underwritten and closed about $1.5 billion with a B of commercial real estate across all asset classes nationally. And I actually started my career with a bank, and I was working in their private bank, which is catering towards the business owners and the high net worth individuals. I was doing a lot of real estate lending, but it was not just commercial. I was doing some residential, and it really just gave me a foundation for credit underwriting and really understanding how to look at a transaction, and knew that I wanted to go full time into commercial real estate. I ended up joining a small boutique mortgage banking firm based in Los Angeles, George Elkins Mortgage Banking, and we ultimately sold that firm to Walker and Dunlop in 2016. And the reason we sold it was Walker and Dunlop has a direct platform for agency lending for Fannie Mae, Freddie Mac, and HUD, which we didn't have access to as a mortgage banker. And so we knew that having the ability to wear three hats, which is one, a direct lender, B, a correspondent lender for our life insurance companies, and C, to be an intermediary, having that trifecta is a huge value add to our clients, and something that we really had to do, because ultimately now that when we're hired, we're agnostic as to who the ultimate capital source is that funds a certain transaction, so long as it's best in class and best in market financing for that asset, for that business plan, and for that owner.
Yeah, that's great. So you have, like you said, $1.5 billion. You've done a whole lot of things. You've been in this field for a long time. So I just wanted people to get to know you a bit. And like I mentioned, you've come and shared at our meetup, and I've just always been impressed with your knowledge of the market. So let's talk for a minute about multifamily. Obviously, today there's two major types of debt people get for large multifamily, kind of like what we do. And it's either agency debt, which is long-term fixed debt. The downside, obviously, there's prepayment penalties, which we have paid millions of dollars of prepayment penalties, and so a lot of times there's this tendency to move to bridge. Mm-hmm. Which do you think is better, and for what type of assets? I know it's a very loaded question, and it depends, but give us the depends on what. Like, what does that depend on?
Yeah, and better is relative, right? And it really depends, because it depends on a multitude of factors. One is what's the business plan? What's the duration of that business plan? What's your exit? And what do your investors need? And so there are so many things that go into that. But at the most base level, in a rising rate environment, I always recommend that my clients take fixed rate debt if they can take it, if they can find it. It tends to give you more. It may be inflexible from a prepayment standpoint. It gives you more flexibility in terms of cash flow and operating the asset. Because if you get stuck with a floating rate loan that you underwrote at 4%, that's actually now 6 to 6.5%, you may be underwater faster than you know it. And so, listen, we're still funding both. Floating rate debt tends to offer higher leverage than fixed rate debt. And you can use somewhat of pro forma future rents in your underwriting, which allows you to then obtain higher leverage day one going in. But again, it's a riskier play, because you need to make sure that even though you're buying an interest rate cap associated with that, you're liable for the payments up until that cap kicks in, which is usually about a 200 to 250 basis point spread above your existing index. And so one thing that we're doing, and it's really fascinating, we actually won a deal recently and got creative, is we ended up structuring a fixed rate bridge loan. And what I mean by that is it has all the features of flexibility of your typical floating rate debt, but your interest rate is fixed. And we did it we did two ways. We did a senior loan with a mezzanine loan behind it to achieve the same leverage that you would get through a traditional floating rate debt. But the fixed rate senior, which was up to about 64% LTV, was fixed at 4.75. And then the mezzanine loan behind that, that's the only portion that had a floating rate component to it. And that was priced much higher, is about SOFR plus 1100-ish. But when you blend the two together, the all-in cost of the capital on this transaction was about 5.5%. And so, interestingly enough, so we're in process. We'll be closing that one likely early next month. But when the sponsor took that deal, we were evaluating it against a traditional floating rate debt offering, and the pricing on that was, call it SOFR plus 370. If you look at it today, SOFR is at 0.8.
So just to clarify, can you tell me what SOFR is if they're not familiar with SOFR?
Sure. Yeah, absolutely. SOFR is the secured overnight financing rate. And so that has replaced LIBOR as the index to which all floating rate debt is tied to. And when you take on a floating rate debt loan, it's priced based on the index plus a spread that is locked. And so your all-in coupon rate is the sum of those two parts. And so the index continues to float. And so that's the risk in a floating rate loan, is that the index continues to rise, making your total all-in coupon and your cost of debt higher as you go through the loan. And so SOFR, when that deal was originally quoted, was about 0.25. Today it's at 0.8. And that is about 35, 40 days afterwards. And if you look at the yield curve for SOFR going forward, which is the best estimation of where we think the curve is going to be, by the end of the year and into early next year, the experts are saying that SOFR could be as high as 200, 250 basis points.
So that's 200 basis points is 2%, or 250 basis points is 2.5%, just as a little key for people that may not understand that. So basically you take the SOFR rate of 0.8, or you take whatever the SOFR is, and you add certain points onto that, and that gets your total rate. I want to touch base on a couple things. It was really interesting what you shared. We recently did a panel with someone on there named Michael Becker. I don't know if you know Michael Becker with Old Capital. He's a lender, and he also is a multifamily guy. And he basically talked about this question about, should we be going bridge or should we be going fixed kind of agency debt? And he said he studied it. He said about 89% of the time, it was actually better to do, it was actually less costly to do bridge debt. But of course, there's sometimes where you can really get a pinch if you have it, and so it can kind of put you in a bind. But he was mentioning that, and historically, as the Fed has tightened rates, because that's the risk right now, is the Fed is going to tighten rates so high that all of a sudden we're at some much higher rate. But that typically that happens on average for 2 years before they start lowering rates, and at the most it's ever been is 3 years. So if, let's say, we did a multifamily deal now with a, let's just say it's 2 years plus 2 or 3 year, 1 year extensions or things like that, you could potentially still be able to carry it through the 5 years, and maybe rates will be coming down on the back end. But again, there's a lot of things we don't know. But it's an interesting thought, because again, we've just had to pay those prepayment penalties a couple times, and they've been very painful, because again, the asset value of a multifamily deal will go up so quickly that you have basically almost twice the equity there, and it's like, gosh, we really want to sell this, we want to do something to redeploy, and you just can't, because you're kind of stuck, and it really limits you. So have you found a lot of people have wanted to refinance with agency debt, or have wanted to kind of free up capital, and they've had trouble doing that, or do they put a second, or what are some ways that people kind of free up that capital if it's tied in an agency deal?
Yeah, so a lot of points there. First, he's exactly right. If you go back starting in 2021 and you look back over the last 10 or 11 years, floating rate debt has historically outperformed fixed rate debt from a yield perspective, meaning that you've done better having floating rate debt. But but that was a bet that you were making, and you would have been right that the Fed was essentially artificially keeping interest rates low. We are now well past that, and we are now in truly a hockey stick of short-term rates. And I think it's a pretty scary place. Now, you could make the bet that it might be for 2 years or less, but again, that's a bet, and that's a risk-based decision that sponsors need to make. The risky part is at the end of the tightening. Typically, that means there's either a soft landing or a hard landing. And what I mean by that is we're entering a recession. And so depending on the type of recession and what the drivers are, you may not have the appreciation that you once thought or you've been used to over the last 3 to 5 years. And so while we've been very spoiled, and you're exactly right, and you know what, we've probably missed some gains by paying prepayment penalties on fixed rate debt. That's a pretty good problem to have because your asset has doubled in value over the 3-year hold period.
Right.
One thing that agency allows, and specifically Fannie Mae and Freddie Mac, is the ability to put supplementals on behind the senior loan. And so what that means is, if you have a fixed rate senior loan at the time of acquisition and you continue to grow rents and grow your NOI, and there's more equity within that property, you can come back to Fannie Mae or Freddie Mac and put a second trust deed or a third trust deed or a fourth trust deed, all known as supplementals, to essentially access that capital. Now, you'll be limited to your original stipulations of your loan. So if you're at 65% and a 135 cover, you can never go above that. But as you continue to drive rents and execute on your business plan, there are ways to actually extract that capital and that equity that you've created. So it's not like you're trapped forever, but you are right that it is more inflexible when you do want to go to sell. So obviously, when we're talking to sponsors, we want to know the business plan. We want to know ultimately what the duration is, and we want to know what their heartburn is. If they do experience or they get an offer that they can't refuse, are they willing to pay those prepayment penalties? Or potentially is something like a floating rate debt execution, which has very limited or no prepayment, might that be a better execution despite the risk of the higher interest rates during the hold term?
It's interesting. My friend George Gammon talks about single family investing these days, and just with rates that are currently out there of 4 to 5%. That if you can get that kind of fixed 30-year debt, that the asset really is the debt more than necessarily the house, because inflation, I mean, it's public numbers 8.3 or 8.5%, but I tend to think it's more like 15% when you count rent growth and other things in there. And so the fact that you get this super low rate for a long period of time can be super valuable. And so I think it's something definitely interesting to think about. I love talking about this. My friend and one partner on some deals, Mark Kenny, talks about this. He says, he's like, because the whole thing is there comes a point in 2 years, 3 years when all this debt needs to be rolled over.
Yep.
And what he was saying on this issue, he said, well, he's like, because we have traditionally been doing like a 3-year with a couple extendable 1-year kind of things, gives us flexibility to refinance or sell whatever. But he said, he's like, if and he's 28 years of experience, 13,000 units. He says, if multifamily is in trouble, then the whole world is in trouble. So the idea of like, if you can't find a way to roll debt over or to do something else. So do you think that maybe over the long term with inflation, 4 or 5 years from now, and obviously we're speculating, but I just want to know Andrew Westling's opinion. Is there just the idea that higher rates over time leads to higher costs of ownership when you combine inflation with it, meaning that it just costs more to operate, to run a place with staff, with inflation, with it's just things, rents are generally going to keep rising regardless of whatever interest rates do. Is that just kind of hard to speculate based on so many factors?
No, I think generally speaking, that's accurate, right? The big variable within that is rent growth, right? So we've all been, again, very spoiled over the last 5 to 7 years, and especially over the last 24 months coming out of the pandemic. I mean, rent growth, this past quarter, we're seeing astronomical rent growth in certain markets. But it's the only way essentially for landlords to keep their costs in check, because the cost of debt has gone up, the cost of labor has gone up, the cost of materials has skyrocketed through the pandemic. So if you are doing any CapEx or deferred maintenance, right, that's costing you an arm and a leg. So what we're really going to, the interesting part to speculate on is what gives first. And I think it has to be rent growth ultimately in certain markets, because at some point the cost of living has to be achievable by your typical working class individuals. And so if landlords continue to increase rents to cover their costs and to keep profitability, you're going to reach that point where no one can afford to live in these properties unless wages go up. And so as wages stagnate because of inflation, then you're going to have a serious issue. And so the Fed 100% has to get their arms around inflation. And the only real way for them to do that, in my eyes, is to continue to raise rates until they have supply and demand in check. At which point, hopefully things begin to level out, including rent growth, because I just don't think it's sustainable.
Yeah, no, I think it's a really good point. Rent growth has just, like you said, been on fire for so long. We're buying a lot in Jacksonville these days, and we're just seeing great growth in all kinds of areas. I mean, still, our what we're seeing for our working class C plus type property is we're buying below what we feel is replacement cost, which is good. And rents have grown a ton. I mean, buying properties that rents are $900 or $1,000, and then the current rents are like $1,425, and just to see that kind of upside is pretty crazy. But but we also see wages rising, and so there's some business friendly stuff there. So Cleveland, Ohio, may not be affected the same as or maybe affected worse than like a place like Jacksonville, where people hopefully will continue to want to move or things like that. Can you talk to us about areas of the country? I mean, are you a big fan of the Sun Belt, or what kind of areas are you seeing things that will continue regardless of, I mean, is that all based on migration, or is that based on other factors as well?
Yeah, it's two things. It's net migration, but that's driven by job growth. And so it's really, where are jobs being created? And so we call them the smile states. If you look at a map of the United States, it's essentially a big smiley face with two dots, one for Denver, one for maybe Columbus, Ohio, right? So, and Seattle. But that Sun Belt, I mean, it's just, you can't deny the facts. So many people are moving there. And so many jobs are being created there, and wages are growing still there, that we are extremely bullish on multifamily and actually single family and build for rent in all of those areas. So absolutely, it is an inequitable market. But that also creates opportunities, right? So you can buy potentially in some other markets that aren't in those states because competition may be a little bit less fierce. There still may be some good market dynamics, but they're being overlooked because so much capital is being poured into the same markets in the South and Southeast.
Yeah, it's really interesting that, I see these markets, and I actually really like secondary or even tertiary markets down there because it's so much more affordable. People can still get, no income tax in Florida or some of these other states, and there's so much growth. I mean, for example, Jacksonville, 300,000 at least at this time will still buy you a decent house, and people can retire. And then for every retiree that moves there, they've got to have all these services and retail and other, the healthcare and other things that have to be there as well. So I think it's really interesting to watch. But that's why the rising tide will lift all boats, and just being in the right markets, really pretty much in any market, whether you're in a recession or not, if people are moving there, it's going to be a good place to be in general. Where do you see, let's just talk a little bit about inflation and kind of what you see in the U.S. Obviously, it affects multifamily, but do you see the U.S. really being able to effectively curb inflation, or are they, if they see a crash in asset values, particularly the stock market, are they going to back off? Or do you think do you think he is going to become Paul Volcker and raise rates as high as possible? And what do you kind of see happening there?
Yeah, my personal opinion is that he has been really strong with the language in anticipation of almost baking in what they want to happen, so that ultimately later this year or early next year, they won't have to continue to raise interest rates. Sort of the message will have gotten across through these first couple 50 basis point interest rate hikes. And that at which point, they will have curbed supply and demand, but also the market will have brought itself back into line and expectations back in line. Right. Whether that happens again, that's hard to say. But I do think that you're right. The public inflation rate of 8.3%, I don't know if that's actually the true inflation rate. And so if it is higher than that, then, they may not be telling us everything that they know, and they may need every last interest rate hike to get there. But again, from all the language I can hear, it sounds like a soft landing is going to be very difficult for the Fed to pull off. And so I would definitely anticipate at some point in the future that we will have some recession or recession-like market dynamics. My gut tells me we're a long way off from that, just based on the rest of the fundamentals in the market. Ideally, my personal opinion is I think we have until about summer of 2025. But I've heard other people that think we'll be in a recession in 6 to 9 months. So again, part of it is managing expectations and risk tolerance. When you're looking at debt, bringing this full circle to commercial real estate, what are your expectations? If you think we have the runway, you can make a decision to maybe take floating rate debt. And if you don't, like you said, having great fixed rate debt is an asset to you on your balance sheet. And so do you want to make that bet now? And if so, how aggressive do you want to bet on it?
Yeah, absolutely. No, there are a lot of factors going here, and it's interesting too that we have, monetary factors, and then you have fiscal factors. So you have, the how much money is being actually created, or how many new, projects or things are going for, and then we have our, our budget deficit, or we're continuing to spend more than we take in. We're continuing to consume more. The U.S. typically has been a 70% consumption in the economy, and obviously now with COVID, we've been producing a lot less goods and services, and then created all this money, which is that's the recipe for inflation, right? So it's kind of a crazy time. What are some things you think that new investors should be paying attention to? Obviously, there's a lot going on, but what are some things that you think if I'm kind of new to this, what are some things I should do to learn more?
Yeah, I would follow migration tracking. There's some really good websites out there. The government actually posts this data to see where people are moving to. For me, that's always been a driver for personal investments, and sort of wanting to get ahead of the curve and saying, okay, why are people moving there, and understanding the reasons that someone would move their family or their business to another state, and understanding the benefits of going there, because there are some long-term ramifications and some benefits for being in certain places in this country, without a doubt. The other thing, if I was new at this point in the cycle, I think we are, by most accounts, maybe an extra innings, right? We are with inflation, especially, looking down the barrel of a potential another recession or recession-like environment. What are some asset classes out there maybe that thrive in a recessionary environment? Because maybe now is a good time to start looking at investing in those assets who may actually outperform during a recession. And so things like self-storage or manufactured home communities, right? Typically, these types of asset classes do better than the rest of the market. So it might be a really interesting time to look at some, counterintuitive, be a little bit early on those to get ahead of it if there is actually a recession coming down the road.
Yeah, it's interesting. This is kind of the longest it's been since we've had a recession, and they've kind of done everything to try to avoid a recession, which recessions are usually pretty natural. Every 5 to 8 years or whatever, there's a recession, and now it could be worse. There's a guy named Howard Marks that says that there's a pendulum, right? It's like the economy is like a pendulum. The further things swing one way, it's almost the further they have to go back the other way. And that's been my concern about all this easy money and all this stuff like that. So. Awesome. Well, Andrew, I really appreciate you. Every time I talk to you, I learn something. You bring so much value. You're just really trying to help so many people. And I just want to say thank you for coming on the Mailbox Money Show and sharing all this. What's a good way that people can reach out to you?
Yeah, so I think you'll be posting some links. We have through our website, walkerdunlop.com. You can reach out to me directly by phone or email. We have a team that's always willing to answer questions, be a resource, help you look at transactions. We're always available for investors and for clients. So please use us, leverage us, especially in volatile times. We have a lot of data to share, and we're happy to share it so that you all are making the best decisions out there for your investments.
Awesome. Well, Andrew, thanks so much again for coming. Look forward to catching up with you soon.
Thank you for having me, Bronson. It's been a pleasure.
So what I want you to do as you've listened to this is really examine kind of where you're at and what your beliefs are based on what you think is going to happen. If you're not sure, that's okay, right? Interest rates are rising generally reduces asset prices, but there's all this new money, this flood, 40.9% more currency or money in banks than there were just 2 years ago, which is crazy. So if you're interested to see more about this, you can go search the stat, which is M2, which is the Federal Reserve amount they study. You can see it's like a hockey stick curve that shows how much new currency has been created. And it's shocking. The other site to check out is one called Shadow Stats. Now, Shadow Stats is a site that basically, if you take into previous measures of inflation, it actually calculates, if you use 1980 metrics, which is what they did, we're actually at about 16.5% inflation right now. So if you include things like rent at the correct level and other things like that. So if I have some videos on about why I think the CPI, which is the Consumer Price Index, is a lie. That you can check that out on YouTube. I've got some videos and some blog articles on my website about that. So you can check that out. But anyway, I really, to the core of my heart, believe that multifamily is going to be a great asset because it's in short supply. We're 6.8 million apartment units short, according to one study. Basically, we've got all this new currency out there that's leading to high inflation. When high inflation happens, rents continue to rise. So that's really where I've put a lot of my cash. So if cash is just sitting in the bank now, you can do that to wait for a buying opportunity, but at a cost of between 8 and 16.5%. So something to think about. But anyway, I hope you enjoyed this interview. Really like talking with Andrew. I hope I get a chance to connect with you. If we haven't connected yet, reach out to me on social media. I'd love to hear from you. If you're interested in joining us on our deals, you can go to bronsonequity.com and you can hit the join button and we can schedule a call with you and set up a relationship with you. So thanks for taking the time to educate yourself. We look forward to seeing you on the next episode of Mailbox Money.
You've been listening to the Mailbox Money Podcast. For more free resources, articles, and videos, go to bronsonequity.com. There you can download your copy of the special report, The Single Best Investment Strategy During and After a Pandemic. None of the information shared here is an offer to buy a specific investment, and this is for educational purposes only. Consult your financial, legal, and tax professionals and use your own common sense before making any investment decisions. Thanks for joining us, and be sure to tune in next time for more Mailbox Money.